when you place your stop loss down here, when can you and when do I move my stop loss? Well, you have to determine where you're getting in at and where you're trying to get as a target. So that's your range from 37.54 3/4 to 37.80 1/4. So technically 25.5 points. Okay, so what is that? 12 3/4 points, something like that. Let's round it to 12.5 points. If we see price move 12.5 points above the entry point that you entered at, if it moves 12.5 points, your stop loss can move 25% up. From where? What's 25% of what range? Where your stop loss is and your entry. So split that range in terms of points. If this goes up 12.5 points, which would be 50% of your expected range, then your stop loss can be reduced or trimmed down to 25%. So it's going to give you that little bit of a cookie, that feel-good moment. You trimmed some of the risk. You're not jamming it up above the break even because you're going to worry about it. You're just moving a little bit. For now, this is the framework for today. We had sell side liquidity here. The market dropped down, took that sell side out, rallied up. Buy side here. I was looking for 38.05 level today, and this is the reason why. And I was looking at it early on in the morning. I wanted to see it run up here and hit that. If it was going to hit it, I would have been watching for a potential short to form, but it didn't do it. And the market started to run up, and we took out the buy side here. But again, I was aiming for this. This is what I wanted to see. I want to see it run up here. And I actually took a long in here. I was wanting to see it run up into that level, and I was going to do a reversal. But we have a fair value gap on the 15-minute time frame here. See that? So the market eventually, after running the buy side here, drew all the way down, took out sell side here, overrun this fair value gap here. Why did it do that? Because this is a larger one. So if it's going to go over top of this one and trade to the top of this candle, which is the low end of that fair value gap that's here, that's not noted on showing you by the respective candles. If it's going to go here, that's also the high end of the fair value gap here. So it's likely to go over top of this one and run into this one. Okay, and it does that as we're going into the noon lunch hour in New York until 1 o'clock, where it makes the low of the session after closing in the fair value gap. And then the 1:30 to 4 New York local time, that's the PM session, New York index PM session, or afternoon session for index trading. So the expectation of going to that specific level, let me explain to you what I was looking for. I wanted it to go above, hit that, and then sell off and go down to this area here for a discount, and then create the run, and then go beyond 38.05. That's what I was really looking for today. That's what I wanted to do, but it failed to get to 38.05. It fell down into this area here, and I knew once it broke here, I don't want to go short because I'm going into lunch hour, and I was concerned it was going to consolidate a lot and then take forever to get down into, and I don't want to hold anything new into lunch. So I'd prefer to see some kind of a stop run in the lunch hour, which is what we're seeing here. It runs down below that and into a fair value gap, deep discount between low, high, trades down into it, and then rallies up. The market starts to rally away, drops back down into an order block, a fair value gap on a 5-minute chart. Then we have a shift in market structure here on the 5-minute chart. Creates a small little return to a fair value gap there, rallies, another fair value gap, it runs into it here, rallies, and eventually takes out the short-term high of the day, and then runs to the level I was drawing your attention to on Twitter. Turning basically at the low of the session at the low end of the fair value gap at 1 o'clock. So closure of lunch time hour, it creates that low. This right here is the 2-minute chart, and this is the fair value gap I drew your attention to live. And it came down into it here, and inside this fair value gap is basically drawing your attention to that as a potential long I did, and I was looking for a run into 38.05, and it started the run, took out the buy side here. I mentioned the buy side would likely be a draw on liquidity. It was, but I wanted to see it draw up to here. That's the specific level I was looking for. And the market comes back down into the fair value gap again once more, and then rallies above the short-term high here. But once it came back down in, it stopped me out because I rolled my stop up to a level that I wasn't willing to weather a deeper retracement, because this is the takeaway. Fair value gap, we trade down into it, we get movement. That's good. Comes back down in again, complete closure of the fair value gap. Okay, that's acceptable. The market dropped back down and didn't quite take out this short-term low with any displacement. So while this fair value gap exists, it's not one that I would have taken, because we didn't see a displacement with meaningful movement below that low. So this is not a fair value gap that I would have been a participant in. All right, here is the afternoon session, and this is where we're going to be doing the bulk of the discussion on the remaining portion of this video. And I'll frame the logic around risk management and stop loss management, and that'll complete the model. The rules I'm going to give you are static. They're always the same, so that way you know once you put a position on your demo account, where is your stop, how much are you risking, when do you move your stop. I'm going to show you the rules I follow, so that way it makes sense to you, and it'll help you also trust taking partials, letting that become a better way of managing a position and trade, and not be fearful about being stopped out, because the stop loss is there to do its job. You pay it well to do that. But if you're worrying about that stop loss being tripped versus following along in price action and continuously measuring whether or not price is giving you what you're expecting in terms of bullishness or bearishness, is the institutional order flow still bullish if you're long, or is it still bearish when you're short? Those types of things are more important than worrying about whether you're going to get stopped out or not. That's not to minimize, obviously, the risk that's respected. Obviously, you should be respecting the risk by actually putting a hard stop in. But if you don't put a hard stop in, you're not really respecting the risk. Here, it's a 2-minute chart showing the afternoon or PM session for index futures. And you can see we traded down into, this is showing a weird time because it's 2 minutes, but this is the 1 o'clock hour. It hits the low and then starts to rally up. Short-term shift in market structure here. Key time of day, 1:30. It trades back down into an order block, last down close candle. There is a fair value gap right here. I didn't note it because it's going to be too cluttered up, and I'm going to be basically doing a lot of discussion in this area, and I don't want it to be overlapped with too many things to be navigating. So this is the 15-minute fair value gap, and it's trading down to an order block after a shift in market structure, after trading down and closing in a 15-minute time frame, fair value gap, and then it trades into an optimal trade entry, which is the flagship pattern of this YouTube channel. Fair value gap with an order block and optimal trade entry is the gold standard of the ICT pattern that's taught on this YouTube channel. This is where you can be long and expect price to reach for here and here. Okay, so we have objectives in here where we can look for this imbalance here, buy side liquidity here, buy side liquidity here, and we'll watch and see, does it continuously march higher. All right, so we're zoomed in here and looking at the 5-minute chart, and again, that's the fair value gap we're going to be using here to frame it. So if you're looking at the idea of you traded down into that fair value gap, does it show willingness to go higher? Yes. Is there a short-term shift in market structure? Yes. Is there a gap? Yes. Down close candle to the left of it? Yes. Drops down in, bullish order block, optimal trade entry. In other words, that would be a 62 to 79% retracement level, less than equilibrium relative to the high and the low, respectively. So we would be looking for a limit order to be at 37.5475. We'll use that. Okay, so 1/4 point less than this candle's low. So that would be our hypothetical limit order to buy going long, and we have to use the low here for our stop loss. So 37.45 0.75. Essentially 9 points of risk. Okay, so we'll come back to that in a couple of minutes, but for now, what we'll be reaching for, what will be the draw on liquidity. From this high down to that low, we want to get to a premium level. 50% is about right in here, eyeballing it. We don't need to have a fib on that. You should do it for yourself. But then we have this imbalance here. So the first low-hanging fruit objective would be this candle's high. That's 37.80 and a quarter. All right, so risk management. Anytime you're trying to consider what lot size or how much you're supposed to be trading or whatever, there are free tools if you Google them. Okay, it's amazing how many folks ask me and other educators out there the most simplest questions that are answered just by a Google search. Okay, I know it feels easier. I think it's a matter of just getting a personal response from the educator or whoever it is that you're asking. And it's not possible for me to go through every single person's question and reply to them. So hopefully you understand that there's just simply no way for me to do that. I don't have enough time in the day to do that. Nobody really does. But simple things like lot size calculators. Okay, you can do a Google search on that, and there are some wonderful free applications and tools that will make that known to you by you just plugging in how much money you have in your account, what risk percentage are you trying to use, what size stop loss are you going to use, and it'll tell you how much leverage, if you're trading Forex, or what your lot size should be for futures. Now, I understand that's probably not the response that you're wanting, because you want to have an interactive experience with your educator or mentor. But these are really basic types of things that could be learned and understood and found the solution to by simply doing a little bit of the legwork yourself. With that said, I'm going to give you one example here and just kind of like walk it out for you. Assuming you had $10,000 and you're trading index futures, and you are using this trade idea that I'm outlining here that I was monitoring in the afternoon session. $10,000 is your equity. You want to take 1% risk per trade. So you're going to take that $10,000 times it by 0.01. That's going to give you a figure of 100. That's $100. That's what 1% of $10,000 is. That means that's the total amount of risk that you're willing to assume. We determined from the hypothetical entry of your demo account at 37.54 3/4 and a stop at 37.45 3/4. That's 9 points or 9 handles. Okay, that's what that 9 is. So we're taking the dollar amount, which is the 1% of our equity, giving us $100 or 1% of $10,000. Total movement that we're willing to absorb as a risk or a stop loss is 9 points. So we take 9, divide that into 100. That gives us 11. Okay, 11 times we can get the figure 9. That 11, if we're going to trade a mini or E-mini futures contract on the S&P, the multiplier per contract is $50. So divide 50 into 11. You can't. So you right away you can't trade a mini if you're going to be risking 1%. So you have to drop down into the micros. So now we have 11 with the multiple of 5. So a micro lot on E-mini micro, instead of $50 per point, it's $5 per point. So how many 5s can you go into 11 with it? 2. So you can do 2 micro lots. Now, this might not be for you, because when I do risk management, I don't really factor in commissions. I'll just do the math like this. So you might look at that and say, well, what about commissions? That might not allow me to do 1%. If you're going to be very hardline about the risk management, and I get it, some of you should be like that in the beginning. But as you get more experience, you'll start thinking, oh, well, the covered costs of commissions and such, over time, that's fine. I'll work that out. But for risk management, just for the entry to stop loss, not factoring commission costs and fees with your broker or spread, okay, all those ideas need to be considered. But we're going to assume that they're not going to be considered for this example. You have to figure that out on your own if that's how you're going to do your risk management. But for me, I don't ever factor in the costs because costs are always going to be, they're like taxes. You can't avoid them. So just, you eat it, okay? So you can do 2 micro lots at $5 per point, making profit or taking in drawdown or loss per point fluctuation. So if we're buying at 37.54 in 3/4 and we're risking 9 points, how much money is that? $90 risk. So we're under 1%. So we're not even risking a full 1%. Our target is 25.5 points or $255 because 2 micro at $5 at the multiplier of each point. 2 times 5 is 10. So you're making $10 per point because you're holding 2 micros. So 25.5 points here at $10 total multiplier based on the 2 micro lots, which would be basically 2.25% return.